Hello, everyone. I'm Scott Sowell from Amvest Capital. We're thrilled to have you join us for today's live webinar entitled Mastering Mining Investments, Navigating Risks and Environmental Responsibilities, brought to you by our team at Amvest Terraden. A special thanks to our partners at Cohera for making this webcast possible. Before we dive in, a quick disclaimer. This webinar is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as a basis for investment decisions. Now, we also have an additional disclaimer from Cohera. I want to take a minute to introduce you to Amvest Terraden, the driving force behind today's webinar. Our focus is on companies that explore, develop, and extract critical minerals. These minerals are not just resources, they are the building blocks of the technologies that are shaping our future. From transportation to energy generation and storage, these technologies span various sectors. What sets Terraden apart is our unwavering commitment to ESG compliance. We exclusively support companies operating within the Western value chain, ensuring they are not tied to Chinese or Russian interests. This approach aligns with our dedication to sustainability and responsible resourcing. Joining me today are my esteemed colleagues, Stuart Macliver and Tomasz Nadrowski, co-founders of Amvest Terraden. Their extensive knowledge and combined experience in natural resource investments make them the perfect guide for today's webinar. Stuart is not only a co-founder of Amvest Terraden, but also the managing partner of Amvest Capital, a New York-based specialist investment management and corporate finance firm dedicated to the natural resources sector. Based in New York, Stuart combines his finance and geology expertise to evaluate natural resource opportunities from both the technical and financial perspectives. With extensive experience in corporate advisory and transactions, Stuart has worked across M&A, equity, and debt capital markets in the natural resources sector. He holds a Bachelor of Commerce from the University of Western Australia, is a member of the Institute of Chartered Accountants in Australia, and has a graduate diploma in geology from the Western Australian School of Mines. His unique blend of financial acumen and geological knowledge makes him a valuable resource in understanding the economic and environmental implications of critical minerals. Tomasz Nadrowski is our portfolio manager. He is a seasoned expert in mining investments with over 25 years of global experience. His career includes roles as portfolio manager, commodity strategist, and commodity analyst at various firms across North America, London, the Netherlands, and Johannesburg. Tomasz is a former director of the World Economic Forum, holds the CFA charter, and is fluent in an impressive 7 languages. He earned advanced degrees from the School of Economics and Social Sciences and the University of Geneva. For many generalist investors, the mining sector can seem daunting due to long-term risks and the time it takes for projects to generate cash flow. However, these risks can be effectively managed with the right strategies. Today, we'll walk you through the entire life cycle of a mining investment, from initial exploration to reclamation, covering how to manage long-term duration risks, quantify uncertainties, and address environmental and social challenges. We'll also share reclamation success stories that highlight how effective strategies can balance operational goals with environmental stewardship. Following the formal presentation, we'll open the floor for questions. We especially value questions from our audience, so please submit yours in the chat or questions tab, and I'll try to ask them on your behalf in real time. While we are headquartered in New York City, today our team is coming to you from across the globe. I'm speaking to you from Miami. Tomasz is in the heart of Midtown Manhattan, and Stuart is joining us from his hometown of Perth, Australia, where many of our mining companies we work with are based. Despite the distances, we're united in our commitment to provide you the best insights in today's discussion. And so with that, I'll turn the floor over to Tomasz, who will guide you through today's webinar.
Thank you, Scott, and good morning or good afternoon, everyone. We thought today would be a good opportunity to misspell certain myths about mining, especially 2 myths. One, that it's very risky, and secondly, that it's extremely dirty. We'll cover the risky part, and then Stuart will continue on the dirty, or actually quite clean side of mining industry. So let's start with risk. Of course, mining involves long lead times, and the further we are from cash flow generation, the less discernment we have about possible futures, if anything, because of the sheer number of variables that can intervene between now and then. So this is one of the reasons why investors agonize about certain issues, such as, for example, the unpredictable changes to regulatory, legal, or fiscal framework that could intervene during those long lead times. They are concerned about exposure to exotic jurisdictions, especially given the geographically captive nature of fixed assets and bankable reserves in mining. They're also worried that each project is actually quite different geologically, especially. So it's very difficult to work from analogs or perfect analogs. Then they fret about the presence of strong opposition to mining, especially in the developed nations. Groups that have learned how to game the system very well, not least here in the United States. And then finally, there are two other issues. The fact that, of course, producers are price takers and prices are volatile. That bothers investors a little more than oil and gas industry because of that long duration to cash flow, longer than the case of oil and gas. And finally, there is also the abstruse nature of knowledge you need to actually analyze this industry. Think about structural geology in such difficult environment as Canada. Think about inorganic chemistry that most of us haven't touched since high school, environmental engineering, and so on. So this last point, the last 2 points, are actually those that you can leave to the mining company's management to handle. But what about the others? In fact, the others have pretty much a see-through negative value on the perception of the investor. But investors can do quite a lot about it because some of these elements can be modeled, and we just need to break them into bite-sized pieces. And if we do, then all of a sudden mining appears less risky. So before we get there, let me state that there is a certain confusion about the term risk itself. That's mostly because we in financial industry tend to look at risk as a function of the portfolio return, right? So in liquid investments, it's simply variance. There's dispersion around expected returns. And we hold this view because in liquid markets, we deal with a wealth of data, a lot of iterations, and now, of course, with algorithmic engines, it's pretty easy to handle those data. But that's not how a mining company perceives risk. Each mining project will be evaluated by its promoters and by their financial backers from the perspective of both positive utility, so return that it can bring, and negative utility. So essentially, this is a sum of products of negative value generated by various hazards or impacts of those hazards, and the probability of those hazards occurring. Such hazards could be, for example, tailings dam failure, as we saw earlier this year in Turkey, not so long in Brazil on 2 occasions, or even in Canada. Or it could be a security incident. I mentioned those exotic jurisdictions. In recent years, mining employees died or were killed in Mali, in Burkina Faso, or even in Colombia. And then you have occasions such as sudden changes to a tax regime or royalty regime, sometimes ex post. And we've seen historically such cases in Zambia or even in Queensland. So just to make my point legible here, we'll focus on mostly non-technical issues. So not necessarily geological or metallurgical question marks, but rather background issues. We can treat all potential changes to the observable status quo as factors. And these factors will affect either the size of the cash flow in future or the timing of those cash flows. So in either case, affecting the net present value of those cash flows. Factors can be grouped together. You can group them depending on the main interest, for example, looking at the gatekeeping issues, the permitting, and the financing side. Another group of factors relates to adverse developments in terms of the security of tenure, then security of future earnings, cross-border flows, and finally the safety, physical safety of the team and the assets. But too often, investors confuse risk with status quo issues. Now, status quo issues are observable facts. Even if they're very damaging. For example, a high royalty regime today that exists today, or a war, let's say in Burma or in Donbass, are not risk factors because they're observables. A question of how royalty is right now in a given jurisdiction is therefore a factual question. It is easily factored into your spreadsheet, and it doesn't really represent risk, but rather a cost. Well, in this case, intervening at the top line. And these observable status quo issues are best addressed by baseline studies. And of course, mining companies spend an inordinate time perfecting such studies. So once such a qualitative study has been completed, it is actually quite advisable to normalize the data around certain central tendency. It's often done through benchmarking analysis, comparative analysis of different projects, and then the status quo issues can appear on some scale from 0 to 5, 0 to 10, depending on the severity. In case of royalty, 0 would be there is no royalty on a given tenement, and then maximum on the scale would be something a cross overriding royalty of 5% or more, right? For the sake of argument. But these are status quo issues. Risk factor, on the other hand, reflects the future adverse change to that status quo. For example, any future movement of royalty from, say, 0% to higher, say 5%, even applied regardless of the grandfathering clauses that may have been assigned at the beginning of the project. In other words, each of these risk factors can be understood as the difference between the status quo observables and the product of the given hazard and its probability. So let us focus on this possible change. The possible change is, so this product of that multiplication, hazard times probability. It may be easily conceptualized as falling into 4 cardinal categories, so 4 ideal types, because any hazard can be either severe or not, or probability can be high and low. So let's say 4 ideal types of risks. Now, which ones of those matter most to us? Well, naturally, we're mostly interested in high impact events, so significant hazards, such as those spectacular and potentially deadly tailings dam disasters. But do we care more about rare hazards or about hazards that occur frequently? Well, the answer is that it's really those high impact events that occur infrequently that keep us awake. Well, why is that? Because if a damaging event occurs historically with high frequency, say a conflict within some local community, then we are likely to pay a lot more attention to it and manage it accordingly, reducing the mining company's sensitivity to that hazard, either by mitigating the impact or by reducing probability of that occurrence. I'll give you an example, which is non-mining. So earlier this year, there was a big earthquake in Taiwan, 7.4 magnitude, and 18 people died. A very similar earthquake happened 25 years before in 1999, 7.6 magnitude, and 2,400 people died, 2,400 people. So the government learned, thanks to relative frequency of these events, how to manage the impact. Of course, with different building codes, different regulations, and so on. So even if there is a slight differences in magnitude, which is about 1.9 times more in 99 compared to this year's earthquake, we didn't see 133 times more people dying this year. So that's the example of managing the impact on something that's relatively, in geological terms, high frequency. It's much tougher in low frequency. So if such an earthquake happened, for example, here in New York City tonight, we would have a completely different impact. So what the government did and what mining companies do, they, of course, have various different types of sensitivity to that hazard. And it's actually worth perusing over this term for a while, because in any mining company or any business venture, you'll be exposed to 2 types of risks. One is exogenous risks, and one is outcomes of the company's interaction with its environment. So whether it's governments, local communities, or other stakeholders. And these 2 categories of future events are of different nature precisely because of the role that the mining company plays in the way the risk arises or in the way the risk is managed. And it's sometimes the case that foreign languages actually capture this difference in a way that's quite revealing. I like the example from Mandarin Chinese, where there is a difference between the term, which usually gets translated as risk, so weixian, that means a danger that occurs regardless of our risky choices, versus function, which is a risk that emerges due to our actions. So in this case, due to actions of the operating management on the ground and maybe corporate management sitting in the headquarters of the mining company. So one is exogenous risk, the one here on the right, and one is interactive risk. Let us focus first on those exogenous events. So they can be actually analyzed along 2 axes. One is the vertical axis of predictability. We can call them epistemological, so what we can know. And the second is the horizontal axis, which is more ontological. It just asks the question about the nature of the problem. So whether the problem is factual, whether it's formulaic and therefore can be modeled, or whether it's purely conjectural, meaning just basically a guesswork. So factual problems are observables, and therefore they're not really problems unless we disagree about their meaning, which we often do, but it's a question of interpretation, right? On the other hand, most deterministic problems, so further on the right of this horizontal axis, can I just illustrate it with a full slide here? Those deterministic problems are usually quite predictable, except in the case of a so-called chaos theory, where we find nonlinear complex systems, which are very sensitive to initial conditions. You might have heard of butterfly effects, for example, or traffic on the road, or the way liquids behave. So these are formulaic. They exhibit some underlying pattern that can be modeled. And somewhat similar are those sudden dramatic changes, which are captured by catastrophe theory. But moving even further to the right of the horizontal axis, you'll find those purely conjectural types of problems, in other words, stochastic processes, which we normally define as random such as Brownian motion, right? So it's well known to gold investors, so gold equity investors, because gold prices behave like this, with those constantly occurring small random fluctuations. And finally, in the upper right corner here, we end up with highly indeterminate stochastic, these are problems which are non-stationary, continuous, with random probability distributions, and good luck with those. Now, what about the interactive form of risk? Now, some mining risks stem from the way in which mining companies have been established. So this is really a problem that's very specific to this industry, and here's why. Most executives of mining companies have an engineering background, and they tend to view problems as pertaining to closed systems. So some final solution will eventually be found to resolve our dilemma and to maybe remove a hazard. And the hope behind this is that we will proceed as in the case of those, arm's length contractual Anglo-Saxon type of business world that generated so much wealth in the last 250 years. But if a mining company operates, say, in Papua New Guinea, as I had to in the past, then you have to deal with local landholders, and any negotiation will be open-ended. Okay, and I bet you that the B2 Gold's recent deal in Mali with the government will be just one of many open-ended deals. It's a bit like peace with Russians, right? It's always only temporary. So unfortunately, many mining companies that are faced with ontologically conjectural or even determinant problems, they would love to see those stability agreements that are signed by engineers and their lawyers as something stable and final. Very often it's not the case. So we have this clash in case of mining company between the culture and the reality, and that often generates that tension that could lead to some interactive risks. And unfortunately, in the mining space, the company's exposure to risk rises once the capital has been committed. And so in an advanced development stage, you're certainly familiar with the non-red part of this graph, the curve that illustrates value fluctuation of a typical mining project, and it proceeds through different studies to production. And it's when you overlay the company's exposure to exogenous risks, as here in the red, then you can understand shareholders' misgivings, which kick in post-feasibility study. So this is when equity investors begin to flee the company, even though until then they hugged happily this highly attractive exploration play. And this is because, unlike in other sectors, where it's possible, at least in theory, to relocate your long-term assets or your IP, the natural resources, the investments are basically hostages of a given location, meaning that capital commitment and risk exposure are strongly, relatively positively correlated in this industry, and value drops because risk exposure continues to rise with capital expenditure way ahead of the actual value generation. Now, the question naturally arises whether it's possible to inject some discipline into our thinking and make exogenous events appear more interactive and maybe ontologically conjectural problems as more formulaic. And we'll try to show that, in fact, it is possible, and even guesswork can be organized around some very, very simple rules. So let us take an example of a mining company developing a new project in an area that's socially unstable. And here I'm speaking from my personal experience in Colombia from years back. And let us conceptualize the adverse change in terms of security. So either personal security or access security to the mine, or security of the zone, right, due to more generic instability in the region. And as a class of risks, you can simply call it deterioration of the security situation. This will be our risk factor, right? That is potential change compared to the status quo. And the actual impact of such exogenous hazards, for starters, will be broken down by using two dimensions. First, where exactly this hazard may occur, and secondly, how our company can be affected by this. So the first question can be answered in a threefold manner. For example, the security situation may deteriorate either directly at the mine site or a nearby town or settlement, or in both, right? And the second question focuses on the impact of our operation. Is it just random violence that we are facing, or is this violence targeting specifically our company's employees? And so we can use this bifurcation for each of those three localities and end up with 6 scenarios. It does not take long to imagine what the worst case scenario is. And of course, it's a situation when our employees are specifically targeted, and this targeting happens in the direct vicinity of the mine site. All other permutations, or most other permutations, are of lesser impact. Now, what is the consequence of our employees being targeted? Well, it's fairly straightforward. High level of insecurity will certainly negatively affect productivity, maybe employee retention, even our cash flow, because of higher costs of maintaining security. And you can imagine the worst case scenario in which, for example, the mine is cut off from the market by violent locals who block access. So in a simple scale from, say, 1 to 10, we can just determine where the most damaging scenario is, with the other outcomes having consequences which are less damaging. But that's just the hazard. As I mentioned before, risk equals hazard times probability. So we need to ask the question about the probability of this hazard occurring. And here we have to apply probabilities to various nodes in this scenario. So we do not, usually we won't have frequency observations, so we cannot like posit or postulate some probability distribution, Weibull, Rayleigh, Poisson, Pareto, whatever. But it's just important to keep certain rules. So of course, the probability nodes must be mutually exclusive. And if you have done your work on the baseline study, you will know how to interview people to generate those subjective a priori probabilities of the security situation potentially deteriorating at the mine site. So let's say that it's about 20% for the deterioration of the situation, with the remaining 80% that must be allocated to other options. And then we assume that the random violence is more likely than violence targeting the employees, whether it's 70 to 30 or 80 to 20, depending on the location. And of course, we are most interested in this most damaging scenario. The law of conjunction in probabilities will give us the final number, which is about 6% probability for the worst case scenario. But because we also determined the consequence before, 6 times 10, we end up with this number, which is 0.60. This is just one element of our expected loss, because for the expected loss of the entire scenario, all the probability pathways have to be considered together, and considered meaning summed up. So we receive a certain number. This is our risk factor, which this expected loss will have to be subtracted from the observable status quo number that you obtained in the baseline studies. Now, let's park this number aside for a moment, because this exercise as it stands now wouldn't be particularly useful if we didn't take into account how adaptable human beings are, right? So risks are not something that's completely out there. Both we as humans and as miners, we're extremely adaptable. But just think about it. Like, humans live in the Arctic and miners mine in the Arctic. Humans live in humid tropics, and miners also mine in humid tropics. Humans live on the Altiplano in South America, and miners are active there as well. And many years ago, at the World Economic Forum event in Davos, the then CEO of Chile's state-owned miner, Codelco, asked me to translate his prophetic words when he stated that when humans finally conquer other planets, the miners will be the first to conduct economic activity there. And after all these years, from all we know about the approach to astral economic activity, indeed mining, whether mining for minerals or for water, and therefore for oxygen, would be on top of the agenda for such a futuristic venture. So yes, we are highly adaptable, and so are the mining companies, and that's why we have to factor in the risk management capability in a given investable mining company. So it means effectively treating risks as interactive rather than purely exogenous. The company can do something, and quite a lot, about some of those risks, and that means that as an investor, you have to really do your homework on the management, the quality of management. Now, how to do this in, say, our company faces security risks? Well, we all know that in mining, increasing security of a project does not mean equipping the workforce with AK-47s or javelins or something, because in certain environments, you simply cannot outgun the locals, right? So this was, for example, my personal experience in the past in the Democratic Republic of the Congo. But mines do generate value, and also for local communities. So we can take as a proxy for maintaining local peace the company's capability in terms of community relations. And here, this can range from very adversarial relations. We had this experience recently in Panama, the high-profile copper project, through different levels of engagement of social development projects, and all the way to the situation where the company just operates in an uninhabited area. And the problem simply does not arise, therefore, because there is no connectivity with any people there. So the lower the number, the lower the company's sensitivity to the risk factor. And of course, for other risk factors, you have to use other proxies, such as, for example, the quality of your government relations as a proxy for companies' sensitivity to adverse changes to tax rules or regulatory framework in general. I won't dwell on these companies here, but you see that the highest sensitivity is for Indian company that actually does not have any operations in Russia right now, versus at the bottom a company which is government essentially, or at least doesn't have shareholders sitting on the other side of the fence being in conflict with the decision making by the government. And so the mining company's capacity to manage those specific risks, in other words, its sensitivity, can be actually construed as a coefficient for those mining, for the various So for this equation here is resilience to adverse developments, and we see those B coefficients, which are derived from those sensitivity measurements, right? The combination of the sensitivity and the previously defined risk factors, so F here, illustrate the company's relative resilience or lack of resilience. So low sensitivity increases the resilience, high sensitivity risk reduces the resilience. And I'm sure you have noticed what it does. It actually brings the exogenous risk to the realm of interactive manageable risks. And all of this can be captured in this linear factor model. If you want to be really pedantic about it, you can add the constant number first. You can draw it from various listings, rankings like Fraser Index or others to reflect, for example, the fact that you are exposed to a certain jurisdiction, and then you can have this additional residual factor if you have multiple observations, and you can actually adjust your dependent variable to what is actually observable over time. So what I've tried to illustrate here is that despite the elevated level of unpredictability that long lead time projects entail, it's actually possible to model these elements of various futures and to quantify them. And you may ask, so what does this resilience number actually mean? Well, it won't mean much outside of your model, which is no different from any other mapping or modeling exercise, but it may prove very useful, for example, to compare various projects in some more systematized fashion. But I think much more interesting question is where to apply these resilience numbers to the valuation of the company. And here the answer is quite interesting. You see it in the lower equation here. And here's why. So mining is a very capex heavy industry, and most of the big financing decisions are in the hands of bankers. And the bankers step into the fray once the company, initially supported by risk-taking equity investors, has defined proven and probable reserves in the definitive feasibility study. But the problem is that bankers look at their risk exposure by manipulating the discount rate, and there's the denominator in your NPV calculation. And while this kind of approach may be useful in say how to price fixed income product, it doesn't really help the equity investor who is interested in one thing and one thing only, the future cash flow. And so if you imagine, say, a mine with a security problem, say in Colombia, then the worst case outcome is that the hazard actually occurs and the company is unable to ship its product because the only access road has been blocked. Now, in such a case, very little will happen to the discount rate of the company, especially if the company has multiple assets, but a lot will happen to its cash flow. And this has to be reflected in the numerator of the NPV calculations you see here at the bottom. So therefore, this resilience number should be applied to the numerator and not to the discount rate as the bankers would normally do. And I think for equity investors, I think this is the most appropriate solution. So I hope I've been able to illustrate the truth behind Blaise Pascal's famous dictum that it is not certain that everything is uncertain. This is definitely true also when you develop mining projects or where you value mining projects. But of course, the quantification of qualitative risk is only part of the story. It certainly won't do much to alleviate the bad reputation that the mining industry suffers from, especially among environmentally conscious investors. So I'll now let Stuart serenade you through some of the more recent breakthroughs on the environmental frontline. I hope he'll help you demolish some sticky myths about dirty mining.
Thanks for that very detailed overview, Thomas. As mentioned earlier, I'm tuning in from Perth, Australia, so excuse any tiredness with the time difference. But my section, I'm going to go over 4 areas. So the reclamation and rehabilitation case studies in Australia and the USA, mining rehabilitation regulation in Australia, and thirdly, misconceptions of mining's footprint and water consumption, and then lastly, how to mitigate acid mine drainage. So I chose to highlight Minnesota in the US for its mining reclamation case studies since I personally visited a number of them. Minnesota's deepest water body is actually a complex of former mine pits on the Cuyuna Range that have been filled with water since closing in the 1960s. This complex is called the Mahnomen, Arco, and Olsted Lakes, named for 3 adjacent mine pits that have since filled in with water. And part of the lake falls within the Cuyuna Country State Recreation Area. Like many other Minnesota iron mines, the Mahnomen mine helped supply iron to the Ford Motor Company in the early 1900s to create steel for cars, and also helped provide raw materials for World War II. The Ford Motor Company was actually vertically integrated and even had Ford-owned mines to supply Ford-produced cars. We're starting to see this phenomenon come back currently with OEMs going into junior miners. So here, this is located on the Minnesota's Mesabi's Range. This is the Hill Annex Mine, which was operated from 1913 through to the late 1970s. This is one of the state's key iron ore mining sites. After the mine ceased operations, the Iron Range Resources and Rehabilitation Board acquired the site for $1, then converting the community club building into a museum and visitor center. In 1986, the former mine was listed on the National Register of Historic Places. 2 years later, the Minnesota legislature designed Hill Annex Mine as a state park. The Hill Annex Mine serves as an example of how mined lands can cycle successfully through periods of idling, recreational use, and resumed mining while producing economic and community value at each stage of transition. Nestled in the heart of the Mesabi Iron Range in northeastern Minnesota is Biwabik, which is now a small town whose history is closely tied to the iron ore industry. In the late 1800s, iron ore was discovered in the area, leading to a rush of miners and the development of several mines. The town was officially incorporated in 1902 and it continued to thrive as an industrial hub for many years. Today, Biwabik has transitioned from a mining town to a tourist destination. The photo on the left is the Embarrass mine near Biwabik, photographed in 1958. In the center, you can see today that the mine has been rehabilitated into Sabin Lake with a strong fishing community and surrounding golf course. On the right, you can see a group of bikers along the top of Miners Mountain Overlook at Cuyuna Country State Recreation Area in 2021. Now I'm going to go over a few case studies in Australia. On the left, Alcoa mines and rehabilitates approximately 600 hectares each year at its Huntley and Willowdale bauxite mining operations in the Darling Range in Western Australia, which is about 4 hours where I am right now. Coal and Allied's rehabilitation in New South Wales' Hunter Valley has demonstrated that alluvial land use for mining can be rehabilitated to match the crop production of nearby farms. Rehabilitation of the Bluestone Mine's Renison Bell Tin Mine Tailings Storage Facility in Western Tasmania is an example of the application of good science and commitment to solve environmental challenges. Glencore's Little open-cut coal mine has achieved high-quality rehabilitation of grazing pasture, demonstrating that mined land can be returned to productive and sustainable farming. On the right, you'll see rehabilitation work at Crystal Mining's Ginkgo Mineral Sands mine in southwestern New South Wales demonstrates the re-establishment of a semi-arid native vegetation ecosystem in an extremely challenging environment. The Australian mining industry is continuing its efforts to improve rehabilitation methods to ensure mining's compatibility with current and future land uses. Mining rehabilitation in Australia is governed by strict regulatory framework, with state and territory governments responsible for enforcing the rules. Rehabilitation requirements are specified in regulatory approval conditions, and if you don't follow them, then you won't get your mining permit. While the future land use can vary, all states require previously mined land to be made safe, stable, and non-polluting. Companies must regularly report on rehabilitation progress in line with their approval conditions, usually annually. Some of these rules include comprehensive regulation. So mine closure planning and rehabilitation are essential to state-based regulatory approvals. As a condition of mining permits, companies are required to progressively rehabilitate mined land where practical. Rehabilitation bonds are one of the key aspects of this. Operators must provide a cash rehabilitation bond in advance before work begins. These funds are generally intended to cover the full third-party costs of rehabilitating mine sites. This does not remove the obligation for companies to rehabilitate land. Bonds are used only in the unlikely event those obligations cannot be met. Companies are required to provide detailed operational plans that include careful estimates of rehabilitation costs. These are reviewed regularly in line with changes in the mine plan, new information, or improved rehabilitation techniques. Companies need to demonstrate to regulators that rehabilitation objectives have been met before the bond is returned and previously mined land can be divested or otherwise handed back to the local community or the government. Progressive rehabilitation is whereby companies rehabilitate the land as soon as possible after mining operations begin and continue rehabilitation throughout the mining process. Landform restoration is undertaken to reshape landforms into what they look like before there was disturbance. Water management is for water runoff. Revegetation is to support native flora and fauna, and regular reporting to agencies on the status and progress of rehabilitation. Lastly, environmental protection can help minimize harm to the environment. Here we'll go through the life cycle of reclamation policy in Australia, which goes through 3 key phases: before mining, during mining, and post-mining. I covered some of these in the previous slides, but the stages are collecting environmental information. Secondly, land use planning to balance the needs of the community, traditional custodians, and the government. Thirdly, lodging cash security bonds and providing regular updates to the regulators. Having plans in place to protect sensitive plant and animal species. Preparing the site with land clearing for minimal environmental impact, and soil management to ensure that new plants get the best opportunity to grow after mining. Mining's footprint in British Columbia, Canada. Mining accounts for 0.04% of land use in BC, but represents 7% of the province's GDP. Canada's British Columbia is a global leader in the development of socially and environmentally responsible resources. British Columbia covers almost 95 million hectares, more than any European country except Russia. Over 54% of the province's total land is protected, making it one of the world's greenest mining hubs. Despite Australia being one of the largest producers of most commodities globally, only 0.02% of Australia's land mass is occupied by mining. I like to compare the footprint and water use of mining to that of golf courses. The US is home to 43% of the world's golf courses. A typical 150-acre golf course uses approximately 200 million gallons of water a year. This is enough to supply 1,800 residences with 300 gallons per day of water. With around 15,000 golf courses in the US, that is 11,356 gigalitres consumed annually by golf courses in the US. When you compare this to the Australian mining community, in 2002, Australian mining companies consumed 1,504 gigalitres of water in 2022. So golf courses use 7.5 times more water annually than Australia's mining industry. And here you'll see some examples of water usage. So a pair of jeans, To manufacture that, it's about 7,600 liters of water. 1 liter of soda actually consumes 350 liters of water. To produce one motor vehicle requires about 148,000 liters of water. In terms of industries, agriculture is the biggest consumer of water globally, with about 70% of the world's water usage, followed by textile and garments. And then it goes down to mining being 7th, which is about between 2 and 4% of annual water consumption. So one of the, back onto this. And so there are estimated about 2.24 million acres of land on golf course facilities in the US. However, when you compare this to the mines on federal land in the US, there's about 872 mining operations on about 1.3 million acres of federal land. It's interesting to note that 3 million acres of mined land have been restored by US mining companies. One main issue with mining is the acid mine drainage, and it's one of the most significant environmental challenges facing the mining industry worldwide. Acid mine drainage is the outflow of acidic waters caused by the interaction of water with rocks abundant in sulfide minerals. Acid mine drainage typically happens when metal sulfides come into contact with oxygen in the atmosphere and a body of water. Because mining unearths minerals foreign to the surface, it can be a primary source of acid mine drainage. However, with the right rules and regulations, this can be mitigated and controlled. So the lake on the left was from an abandoned mine that had acid drainage from 1914 through to 1980. The lake had a high concentration of iron, sulfate, and toxic metals. After remediation using the natural neutralization method starting in 2003, over the next decade, the lake became neutralized and now has circumneutral water with increased planktonic, phyto, and zooplankton. So some of the key points of how to minimize this starts with regulation. If you don't have proper regulation on a federal basis, this will not be resolved because geology and spills don't care about state borders. You need to have adherence and enforcement of regulations with strict penalties. In the shale and fracking boom of the late 2000s in the United States, the energy companies were cutting corners by not cementing the drill casings, which caused significant chemical leakage in communities. This was compounded by the fact that the EPA was not monitoring these companies and the well casings they were drilling. Secondly, due to the convoluted legal challenging system in the US, with no on-the-spot penalties in place, it took years and millions of dollars in legal bills to fight the energy companies for compensation. If penalties were in place up front, these would have been mitigated. And now I'll hand it off to Scott for some further questions.
Thank you, gentlemen. Fascinating presentation from you both. Stu, we have one audience question that we'll just take from the top since it relates to what you've just been discussing. In Australia, relative to total capex, how big are the rehab bonds?
Off the top of my head, they're nothing crazy, but probably in the kind of 10% of capex, and a lot of it is done on an annual basis. So, if stage one, you're just clearing some land, the rehabilitation costs will be minimal versus, at later stages of the operation, if there's a large open pit, that'd cost more. So, but the key is that every year cash goes into a cash funded bank account that can't be touched by the mining company. So if a company goes bankrupt, the cash is there to turn the land back into what it looked like beforehand. This is a key thing in certain countries. In the US, a lot of the bonds are actually not funded. They're future liabilities. It's kind of like, pension liabilities that aren't funded. So if a company goes bankrupt, walks away, who's going to pay to clean up the mess?
Yeah, just if I can add to this. So the capex, mining capex in Australia sort of fluctuates between $18-20 billion a year. The reason why it's difficult to compare it is because the bonds are priced per hectare. So I think it's $4,000 per hectare, something like that. So that depends on the footprint of the mine. So it's going to be different for, say, bauxite or coal, and different for, Kirkland's gold mine, right?
Victoria. Small underground portal.
Completely, very different footprint. So this is going to fluctuate because of that. So one is area related, one is full capex spent.
Okay. I'm curious, what are the standards governing the mining industry's sustainability commitments?
Oh boy, too many. I think the mining industry has this unfortunate habit of generating a lot of standards, so self-regulatory initiatives. In the late 90s, ICMM, so International Council of Mining and Metals, came with a certain grid. There is the Towards Sustainable Mining initiative. There's International Forum on Mining Metals and I think Sustainable Development. The one I like is called Initiative for Responsible Mining Assurance, IRMA. It's quite granular. It's actually useful for due diligence, but it's a problem. There are too many of those, and I think until green bonds really pick up, I mean, there are some larger mining companies that have issued green bonds, but until they become a significant source of funding, especially for earlier stage, for which would mean there will have to be probably zero coupon or something. Banks will not have a real incentive to actually generate something that will be binding on the company. So for now, it's really self-regulation and congratulatory stuff. And remember, there's a difference between compliance and performance. So somehow, whatever new products will be issued there for financing, will have to fit the regulatory framework and then make sure that the performance improves, not just simply ticking the boxes. So. Good question, but it's a complex matter, and there is no overarching body that would determine which of the standards is dominant.
Great, thanks. If you had to pick only a couple of key factors in a good reclamation and rehab policy, what would they be?
For me, it'd be federal rules. As I mentioned, geology doesn't care about state borders. And, you might have something on the border of Nevada that impacts the, overflows into California, etc. So having, a good federal system in place of regulations. And then second most important thing is the cash bonding. That's definitely a requirement. And, it's actually quite a big industry in Australia whereby, the state regulators and Department of Mines are monitoring and going to check out these mine sites to see if they've followed the steps they said they were going to in their reclamation plans. And every, 6 months, 12 months, if things change or the mine plan changes, you have to update the rehabilitation plan. So, constant communication between the mining company and the regulators as well.
Great, thanks. We'll sort of go back to the beginning of the presentation. You explained how to understand the risk exposure of a single mining project, but not how to de-risk a mining portfolio. Any
well, then as an investor, you have a lot more freedom to de-risk a mining portfolio. So all you need to do is diversify the exposure properly between your equity, your bond exposure, long, short, the duration across, of course, between exploration and cash generation per commodity, per jurisdiction. You can slice it and dice it in 12, 24 different ways to reduce the correlation. Of course, once you have more than 3 assets in a portfolio, for those who have done their CFAs, that's pretty complex. But today, probably with AI, you can actually crack it pretty easily, because what matters more than the standard deviation of each and every single one of your investments is the correlation. And it's a matrix of correlation. Once you start above 3 assets in your portfolio, you should never have less than 20. So I think that's a lot easier. I think still, however, it's good to do this fundamental work on an asset-by-asset basis or mine-by-mine basis if you have time or on your hands or a team to help you.
Stuart, anything to add to that? Or?
No, I think Thomas's answer was pretty in depth.
What can governments do to promote higher mining standards and help improve the reputation of the industry as a whole?
Thomas, you want to get started on that one?
So the first thing that they should do, let's step back. Who's the main trendsetter in terms of regulatory burden in the world? This European Union. So European Union has to actually wake up and generate those technical criteria that would help perfect the financing system for the mining industry. Right now, it's impossible to have a ESG mining focused fund. Article 9 fund. Article 9 funds generally are dwindling in popularity because ESG has become suddenly almost equanimous to woke, at least in this country. I think it's a mistake. But even Article 8, which is somewhat gray rather than green area, even that growth would be helpful. However, it's still not really focused specifically on mining. So I guess the ball is with the European Union. I think they're finding themselves a bit ideologically conflicted. A lot of bureaucratic work done also at the sort of international level, UN, Global Compact, and so on, started from that very skeptical angle vis-a-vis the mining industry that didn't help, and hence this push since late 90s, early 2000s for the mining companies to actually self-regulate as much as possible, especially larger companies trying to appear as those good citizens. I think there's also a lot to learn from those jurisdictions that have actually done a decent job, and of course Australia is way ahead of everybody else. I think some other jurisdictions, Brazil is improving after those two terrible disasters. That has an impact on the cost of your tailings. Dry tailings are not really applicable in every single climate or every single seasonality, so it's a challenge. But if different governments learn from each other a little more, that will be helpful. I do think, however, that the main burden of regulatory push will always come from EU, and then it sort of spreads out and other countries pick on this. US is always good in terms of tax incentives, so often a carrot rather than a whip. That's the right attitude, definitely. And if there was a way to, for example, help with financing through fixed income products that are more attuned to the responsible mining, then certainly the government could help with tax cuts, as we saw with IRA throughout the value chain in 2022. And that would definitely help. I think, as everything in the US, we have to wait until after the election.
And for me, I think companies have to do a lot of education, and the governments on mining as well. And if you look in Canada and Australia, the contribution to GDP for mining is quite massive. And I was in Brazil about a year ago. It was really interesting to see the local communities really getting behind the local mining operations because they were adhering to high standards. They were employing locals. I personally think that, whether it's mining or oil and gas, companies in extractive industries should not be self-regulated. They need to have, policies in place. You've seen this in the fracking industry in the US. A lot of companies cut corners, resulting in a lot of impacts. And then also, I think, with lobbying in the US, any advanced industry is going to keep with, extra cash because they're an advanced industry, a mature industry, paying lobbying to keep things the way they are or reduce regulations so they can make more money. You saw this in the coal industry when gas was becoming more popular in the US. They were pumping heaps of money into Capitol Hill to try and keep, coal plants, as the energy policy of the region, instead of allowing new forms of energy. You're seeing that now with the oil and gas industry, some areas against kind of the mining parts of the energy composition. But I think having, a good framework, an independent framework federally, and then educating communities that, mining can be good for local communities.
Great. I think with that, if you both of you want to share some closing thoughts as we wrap up.
Yes, I hope we have tried to debunk two different types of myths. One related to the difficulty with which especially generalists approach this industry. We understand that it's difficult to turn a head around those long lead times and anything that can intervene during the period, especially as the company is developing a new project, whether it's a company with other assets or a single asset company, especially a single asset company. Personally, I think I realized that the last time the United States had a very significant success in extractive industries that was related to fracking. Fracking is also capex intensive, but it's fast depletion, and most importantly, it's very short duration. So I think U.S. investors in particular are not very comfortable with this long duration. There is no good product for that. Definitely not high yield in this case. And so the industry is suffering from this very high cost of capital, especially high cost of equity, Canadian and Australian. And the US capital base is not incentivized to move into these areas, even though it would be in the interest of economic security of the United States. So, we always hope to kind of contribute to higher literacy, mining literacy among investors and journalist investors, and maybe bring some new investors over the fence. As we tried to explain today, I think there are ways to think about those challenges a little differently in a little more systematized way.
Thanks.
Thanks for that. Yeah, and I think, with sensible policies in place, reclamation and rehabilitation of disturbed land can be done appropriately, and a lot of the environmental risk can be mitigated with sensible policies and cash bondings. So, hopefully this was insightful for people out there that were less familiar with the sector.
Certainly. Well, thank you to both of you for sharing your insights. As we conclude, I want to also thank our audience for your participation and engagement, and our partners at Cohera. A replay will be available following the webinar, and you'll see the contact information for Amvest or for Tomasz and Stuart up on your screen now. So please reach out. You can also visit our website at amvestterraden.com to learn more about our ongoing work. And we hope you will stay engaged, and we look forward to seeing you next time. Thank you and goodbye.
Thank you.
Thank you.